before we dive into the fun world of OBBBA, and again, I've mentioned already to people, I apologize, I will try to say OBBBA correctly each time, but if I miss a B, please forgive me. But before we dive into the world of OBBBA and how it affects state and local taxes, it's always really good to talk about what type of state and local taxes are there. When we talk about SALT, what does that mean? What does it mean to have to file in a state? When do you have to file in a state? So that you know what states we're even talking about before we dive into how the federal law trickles down to these states. So as far as types of state and local taxes, there's four main ideas of state and local taxes. You have your income tax, your tried and true net income tax. It's an annual tax return that's filed and paid, and it's on the net income of a company, both federal and state as well. Then you have your sales tax. Again, something most people are very familiar with. You've got taxes that are imposed on the sale of goods and services. It's usually a % of that sale, and then it's imposed by state and local governments. So sometimes it's together on one return, as many of you know, and sometimes the local counties, areas, etc., administer their own taxes at their own level. So it can get pretty complicated. And then we've got franchise tax. So think about California, Texas, taxes like that in states where it's a gross receipts tax or a gross margin tax. Or a tax on net worth even. So it's the tax of having the privilege to do business in their state. It's a little different than an income tax. It's not on the net income. And then we have local taxes. So those are talked about probably a little less than what we would think. You've got Pittsburgh, Philadelphia, personal property taxes. People don't talk about that too often, but that does affect businesses in other states quite often. And then we've got Chicago taxes. I always mention it because obviously we're just a hop, skip, and a jump away from Chicago. You don't have to have your business in Chicago to have to file taxes in Chicago. And I always like to mention that because people assume you have to be there and running your business there, and it's not exactly true. So what is nexus? You're going to hear us say nexus occasionally throughout this. So nexus is that connection with a state that makes you have a filing requirement in that state, whether it be for sales tax, income tax, franchise tax, local taxes, etc. What is that connection with the state? It used to be super simple. It used to be your physical presence, right? You have an employee there, you have an office location there. It was pretty cut, dry, simple. And over the last 10 to 15 years, it's gotten a little muddy, and they have what we call economic nexus now. And that just means you actually don't have to be physically in a state in any capacity. You just have to sell enough into a state that you now have a filing requirement in the state. And that goes for both income, franchise, and sales taxes. And they all might have different thresholds, which keeps it even spicier and more fun, because why not, right? So when we talk about economic nexus, it's benefiting off of the consumers in that state or in that locality. States are advancing from that physical presence to that economic nexus. So for income tax and franchise tax, we see this most often with service-based companies. Here's some states. I won't read it to you. You guys do have a copy of the presentation, but there's some states here that have an income or franchise tax economic nexus, and they're nice enough to at least give us the threshold. Some states don't give you a bright line test of what those sales are to file. You just have to make almost a best guess as to if it's enough sales in the state. So you've got California at over 757,000 or 25% of your sales. You've got a couple states there, Colorado, Connecticut, Ohio, Pennsylvania, Tennessee, sales over 500,000. New York is a little higher at 1.2. Texas, that's another one we see a lot of our clients in. $500,000 is that threshold. And then New Jersey is at a pretty low threshold of about 100,000. So just keep that in mind. And then we move on to that and we have commercial activity tax or gross receipts tax. So again, this isn't a tax on net income. It's oftentimes at a gross receipts basis, but it's not sales tax. Do not confuse the two. Very separate taxes. The state expects them to be very separate taxes. Ohio just increased theirs to $3 million back in 2024, which was great because prior to that it was much lower, which made a lot more people have to file in the state and pay tax there. And then you'll see a few more there. Another big one we see is Washington Business and Occupation Tax, or B&O tax, at $100,000. So when I'm talking about service-based for a lot of these, a lot of people think, I'm in Illinois. I do my work in Illinois. It's an Illinois sale. If you're a service-based company in any capacity, it's not about where you do the work in most states, like 95% of the states. It's about who's benefiting from your service. So you might do 100% of the work here in Illinois, but if your consumer or your customer is benefiting in California, that's California sale. And that's the really important thing to remember when you're talking about these sales and where you have sales. It's super easy to think that it's just here in Illinois and that's my home base, and that's not true. And it's just making those lines a little bit more blurred, making those lines a little more gray, and making the states be able to tax you at that point in time. And then sales tax, there's economic nexus. You guys probably have heard now, it feels like it's still new, but it's 7 years ago. The Wayfair versus South Dakota court case that went all the way up to the Supreme Court. And the Supreme Court basically said, yep, South Dakota, you're good. You can put in $100,000 or 200 transactions, and you now have to file sales tax in the state. You do not have to be physically in the state, etc. Prior to that court case, you had to have a physical connection with the state to have a filing requirement there. So that kind of blew up the sales tax world. Like I said, that feels like yesterday, but it was 7 years ago. But now that it's been 7 years, we're starting to see the audits, the notices come up, etc. Because now it's been enough time for those states to say, okay, we've got good solid, 5, 6, so many years of history here that we can send something out and say, I think you owe tax in my state. So I mention it because all of this does play into the OBBBA, because you do need to know, where do you even have to file to begin with to know how the new federal laws affect those state laws. And just so that you get the beautiful map here. So for sales tax economic nexus, any state that has sales tax actually in their law has an economic nexus threshold now. So if you sell into a state and you sell enough into a state, you now have to register for sales tax, remit sales tax, if whatever you're selling is taxable. And a good thing to remember also is not every state is like Illinois and just deems goods as taxable. Well, now leases, in case you weren't aware back in January, Illinois charges sales tax on leases now. But outside of that, not every state views just goods as taxable like Illinois. There's a lot of states that actually have services that are taxable. So that's really important to remember as well. Bleeds into both worlds. And before I pass it off to Alex, I do want to mention, I know we talked about economic nexus and everything, which is obviously the newest form of nexus, or having to file in a state, but the tried and true physical connections with the state will still create a filing requirement, right? Employees, independent contractors doing work on your behalf, sales reps, trade shows. Does anybody sell at trade shows? Does anybody go to trade shows? Every state has their allowable amount of time that you can be in the state for a trade show without tripping nexus. Data warehousing. Do you pay to have your data warehoused in a different, like on a server in a different state? If it's certain states like Massachusetts, for example, they actually deem that as having a physical presence in their state. So and if you have cookies on your website that people download, now you've got cookies on somebody's phone in Florida or something, and now you've created a physical presence in Florida. So it gets complicated, and it gets complicated fast. And so that's why we want to talk about this before we dive into the OBBBA, because it is so important to just, one, keep up to date with what's changing, what we're seeing, and two, you got to know where you're going to have to file first to even know how any of this tax law affects you. Alex?
Well, thank you everybody for coming, and thank you, Meaghan, for that intro. I do want to just cover briefly, since a lot of these parts were covered already, just why this stuff matters, why this economic nexus is an issue. Because as we dive into some of the changes that happened federally, you're going to want to know why, at the end of the day, are you going to file or not in a state. And the big thing here is some of these points we've talked about, the resale certificates and exemption certificates, they can prevent you from having a sales tax obligation, but there are so many unique rules. For example, if you happen to use Amazon or any other type of e-commerce service, if they store inventory for you that's ultimately going to be for sale, that inventory can be considered a form of physical presence, which means you could have now the potential filing requirement. And in such a situation, then we want to know, okay, what are some of the provisions that are going to affect me? The other case, and we talked about this briefly with use tax, even if you as a business do not have nexus, whenever a taxable event happens, but the business itself is not subject to tax, you have what's called use tax, which means that usually the requirement to pay the tax falls on the onus of your customers. I know you've all worked really hard to get your customers and your client relationships up. So that can be a major factor here too. You don't want your clients to be hit with a potential tax liability that you could at least communicate with them. And so keeping in mind where that nexus happens is really helpful. And then with regard to some of the things that states will typically do, usually you'll get something called a nexus questionnaire. If you've already seen one before, then it's familiar to you, but it basically is trying to assess what type of business are you doing in the state. Really what's happening there is the state's trying to get a gauge as to what you're doing so that they could potentially inquire further for an audit. So in a situation like that, there's really no statute of limitations, and so you could risk potentially a big audit. And if you've been part of a state audit, I've been part of a few of them in defending, they can be really lengthy and very expensive. So just having a good idea as to where you're at, having an idea of those economic thresholds, physical nexus, and all that stuff, it really gives you the power to know where your risks are and prevent anything unknowable from happening. And then on the last subject with this, if you are selling a business or if you're buying a business, this comes up all the time. I've dealt with businesses that are trying to do an acquisition, and the other business comes up and says, hey, we got our SALT person to evaluate that there are some liabilities and some risks that you haven't covered. We're going to want an escrow on this, or we're going to need to reevaluate this deal. So if you're in a position where you're thinking about selling your business, this is a really important thing. And if you're going to buy a business, same thing. You might be at risk for liabilities that you may otherwise not know. So just having an idea of what the nexus risks are, it's going to give you a huge advantage. So with that, I'm going to pass it on back to Meaghan so that we can get into OBBBA and the state non-compliance or compliance.
Thanks, Alex. All right, so here we are. We're going to talk about OBBBA and states. This is the general idea of what we're going to talk about coming from that federal law that has the biggest effect on states. Obviously, there was a lot more that was in the OBBBA. We did a fantastic presentation on that about a month and a half ago, and we can always send you those slides as well, or that presentation. But these are the ones that affect the state and local taxes the most often. So we've got the SALT deduction cap. I'm sure that was one of the biggest things you heard about. We're going to talk about that in length. And then we've got research and experimentation expenses, bonus depreciation, full expensing of the qualified production property, and interest expense limitation. So we'll go ahead and talk about what the federal side that changed and how that affects the states at that point. So SALT deduction cap, that's probably the one that you guys have heard most about in relation to states in the OBBBA. So back in 2017, there was the 2017 Tax Cuts and Jobs Act that made an adjustment to state and local tax deductions. And when I say that, when you file your personal return, if you itemize on your personal return, there's certain things that you can itemize. There's taxes that you can deduct. There's charitable giving that you can deduct, home mortgage interest that you can deduct, etc. It all adds up, and it says, okay, does your standard deduction outweigh what your itemized deduction is? It takes the bigger benefit for you to deduct it from your income on your personal return. So when we talk about these deduction caps, that's what we're talking about. Who does that affect? When we put a cap in the ability to deduct taxes, that affects people that are living in higher tax states. That affects owners, shareholders, partners of pass-through entities, because as you know, as a pass-through entity, you pay your tax at the personal level. You don't pay the tax at the company level. You might file the return, but you pay the tax at the personal level. So now you're getting limited on the deduction of those state taxes that once before you could deduct. And that was from 2018 to 2025 that $10,000 limit hit. When you think about it, in Illinois specifically too, I mean, when you were looking at taxes, we're talking about income tax and real estate tax. I don't know about you, but my real estate tax bill is pretty close to 10 grand by itself, let alone what I pay in state income tax, right? So being limited on what you can deduct on taxes that you paid really affected people and what they could take for that on their personal return. So that was a big deal. So what states basically are saying, how do we fix this? How do we help people? Because this is hurting, our residents of our states, especially states with those higher income taxes. And so what came out of that was pass-through entity tax. So you've probably heard us say PTE, PTET. Pass-through entity tax is a tax that was created most states starting in 2021 forward. And it's an election that's made annually. And it's a tax that's imposed at the entity level for an S corporation or a partnership. And it's paid at the entity level for the state. And it's treated like a tax deduction at the entity level that then flows down to you personally as a shareholder, partner, etc. So it kind of bypassed that cap on your personal return on the taxes that you paid, and it let that become a federal deduction through the business. Normally, in the past, you may have had, especially if you're multi-state filing, you may have had non-resident withholding that was paid or composite taxes, etc., but they were treated as distributions. This is treated as a straight deduction tax expense. It was great. We were able to use that for a lot of our clients. Obviously, as you probably expect, every state did something a little different when it came to pass-through entity tax. They, of course, didn't all, decide to get on board with one form or one law. So every state did something a little different, whether they treated it as a credit, whether they deducted the income from your personal return, how that was trued up, etc. Some states said if you overpaid in estimates, because you have to pay estimates, you don't get a refund on it. It just carries forward for 5 years. And then basically, if you still don't use the overpayment, then it goes away. So those were the things the discussions that we had to talk about and look at the states that our clients were filing in, because we had to make sure it made sense depending on the states that you're filing in, if pass-through entity tax was going to be beneficial. In probably about 90% of the time, it is, and it still remains beneficial. But this is what came out of that 2017 Tax Cuts and Jobs Act. So because of that, I've got this beautiful chart I'll show you. So these are the top marginal state income taxes. So as you can tell, surprisingly, Illinois is not one of the worst states, but ones that you would expect: California, New York, Washington, Oregon. Hawaii is really, really high as well. We've got DC, those states. And that's just income tax. Again, we're not talking about real estate taxes, etc. So these were the states where the residents were affected the most by that $10,000 cap, which was why a lot of these states were the first ones up to create a pass-through entity tax to help their residents. So the OBBBA raised that SALT cap to $40,000. And that's going through 2029. It's set to expire in 2030. It's $20,000 of a SALT cap if you're married filing separate. That's the only little asterisk to it. It's adjusted upward 1% each year, and it does revert back to the $10,000 in 2030 unless it's extended. So there's also a phase down. So taxpayers that are making over $500,000 or $250,000 for married filing separate only will see that $40,000 cap go back down to $10,000 of a cap. So if you're making what the IRS and the federal government deems as too much money, you still now have that lower cap. So just to let you know about that. So most states are still keeping their pass-through entity tax because there's still a cap in place. A lot of states had their laws written that if the cap went away, that at that point their pass-through entity tax would go away. But there's still a cap in place, so most of these states have kept their pass-through entity tax alive and well. The IRS still deems it as acceptable, that it's a deductible tax expense on the federal return that flows to you personally. I do think it's really important, though, to do an annual review of what this means and if it makes sense. And the reason why they say that, again, is depending on the state mix that we're looking at, and most of you probably file multiple states, especially non-resident ones that we're looking at, we want to make sure that pass-through entity tax still makes sense depending on the state mix that we're looking at. It still might make sense, and it still might be the best option for you. And you still can do the $40,000 cap and the pass-through entity tax. But we just want to make sure on an annual basis, depending on the states, which states make sense with that and what states that we would maybe potentially recommend not doing the pass-through entity tax at that point. And back to Alex here.
Thank you. So I want to talk about one of the provisions that changed. Federally, what happened, and then how the states are responding to it. And so I'll use a little bit of language, but I'll try to keep it fairly clean. So research and experimentation, R&D costs, one of the big changes goes back to a Tax Cut and Jobs Act change, which was that previously you could deduct research and you could deduct your R&D expenses, but due to TCJA, you were required to amortize certain expenses. So if you had domestic expenses, those had to be amortized and capitalized over a 5-year period. And if you had foreign expenses, those had to be amortized and capitalized over a 15-year period. Now, obviously, if you are a business that has significant R&D, that can pose a big challenge because now you don't have that expense available. And so states responded differently. States with constituents who were obviously in the higher tech fields like California, they decoupled from this. And so they allowed you to take a full expense basically. And so what you would see is on your federal return, you would have that expense limitation. On your state return, you'd be fully able to expense the R&D. And so each year you would create an adjustment where for whatever you were taking on an amortized basis for federal, you'd add it back, and then on the state side, you would adjust as needed. Now with OBBBA, one change, which is favorable, is that those R&D expenses that occur on a domestic level now can be expensed. So the foreign element hasn't changed federally, but the domestic one has, beginning after tax periods 12/31/2024 and forward. So the question is, how are states going to respond to this? Most states follow one of 3 methods. Usually the first method is what's called rolling conformity, which means that they update based on what the federal states, whatever the federal does, the states will follow. And they'll typically follow pretty stringently. The other is what's called a specified date conformity, which means that they will follow the federal law based on a specific time period. And then the last one is a nonconformity, usually based on a rule. And so each state has different rules on that. I've listed over here a couple states that conform on a rolling basis. So in these cases, you'll typically see that you're not going to have to make any adjustments from what you're doing federally for Section 174 for the R&D costs and what you're doing on a state side. But for the ones that do, it's a good idea to pay attention because you don't want to be in a situation where you are expecting a significant cost deduction on your federal basis, but then when you go and file the state return, you have a bit of add back. I was able to find that Maryland and Virginia, they have unique rules. Their rule states that if there is a federal change that is for Maryland's case, if there's a federal change that's to cost Maryland more than $5 million in a projected budget, they'll effectively decouple from it. And Virginia follows a 15 million rule. So as of this time, Maryland has produced what's called a 60-day report. And in that, they did say that they are decoupling from Section 174A. So if you're expecting to take a significant R&D expense and you have a heavy presence in Maryland, such as having economic nexus, it would be a good idea to just give that a second look. As of right now, they're only decoupling for 1 year, but it's going to depend on what the state does next year based on their budgetary requirements. You'll see in the bottom, I have some states that have not conformed at all to Section 174A. And in those cases, these are states that previously did not conform to 174. They did not conform to the requirement to amortize those expenses. So Usually, these states are not going to have any change because of the fact that they did not have the requirement in the first place. So you'll likely see, and there'll be continuing developments on this, but you'll likely see that these states are just going to follow what's happening on the federal level for domestic expenses because they never required you to amortize. So bonus depreciation, for some of you, you've probably heard of this. For some of you that haven't, on the tax side of things, the government over years has allowed what's called bonus depreciation, which effectively means instead of having to depreciate an asset over time like you normally would, like let's say over 10 years, they'd allow you to take a percentage immediately. So it could be 80%. So let's say you have $100,000 of an asset. If there's a bonus depreciation rule that allows you to take 80%, you can take $80,000 that year. Obviously, the sacrifice there being that in the next few years, you don't have that big base to take depreciation. So it's an immediate benefit versus a benefit for later. But most people favor that. Most people will favor an immediate benefit. And so over the years, it has changed. But one of the provisions in OBBBA is to permanently extend it to 100% for qualified property placed in service after January 19th, 2025. And I'll get into what that actually means. But the key thing here is that from the state side, not many states conform to this. And this is especially important because if you have significant bonus depreciation, if you have assets that you're purchasing and you expect to take a large cost on that, many states, including the state of Illinois, do not allow you to do that. What they have you do is, if you had that $80,000 deduction, they would require you to add it back in calculating your state tax and then take depreciation on their method. And their method could vary. Sometimes it's just calculate it as you normally would had you not taken it. Sometimes there's a specific percentage that you have to do. But this is especially important just because one of the changes that happen with OBBBA is also the types of assets that can qualify. And so if you anticipate that you're going to have a significant bonus depreciation expense, you should really look at where you're filing. Again, Illinois being one of them, but 2/3 of states do not follow bonus depreciation rules, and they're expected not to. From my research so far, most states haven't spoken on a exclusion where they're going to allow for the changes that are occurring now to override the changes from before. So I would expect that any state that hasn't conformed previously is going to continue to not conform. And over here, I have a bit of detail on what a qualified production property is. It's listed as construction for property within this specific date period, but the key takeaway is that it's incentivizing manufacturing within the United States. That's really the intention behind this. It's for non-resident real property that's emphasizing production activity. And so obviously those assets can have a significant amount of cost associated with them. So you can expect a significant expense in the current year. So that could be a very big benefit for people. But again, if you're filing in the state of Illinois, that's not allowed. And so you're going to want to be on top of the fact that there's no surprises when you go and file your Illinois state return. To change, but as far as we know, really what you want to pay attention to with qualified production property is, one, is it qualified production property, which I'll get into one little detail in a second on, and then two, how are your states going to be affected? Because let's say you do the PTE election that we talked about earlier, and you're expecting to pay tax, but you're depending on a $2 million deduction on this. Illinois might not allow that, so you might see taxes there, and that's a good thing to just keep an eye out on. I do have some states over here that specifically decouple, Maryland again being one of those just because of their regulations. A couple other states, I've just included some quick footnotes on the budgets and the bills, but effectively they have already said that they're not going to follow this. So when you file a return in any of these 4 states, Virginia has temporarily paused ruling conformity, so it hasn't gone out and said we're not going to do it. It's just at this time, it doesn't look like they're going to. So if you file in these states, that expense might not be allowed. Just important to keep that in mind. One point that I wanted to address regarding QPP is just what isn't allowed. At the bottom, I've included things that don't exactly relate to production aren't going to fit that definition. So if you have a sales function building, or if you have a services function building, that's not really always going to qualify. That you're going to have to make sure that you have the documentation to show that these are directly related to production, because again, the real driving purpose behind this change federally was to stimulate domestic production. So it's a good idea to, on the federal side, to pay attention to what you're claiming for this, but then also on the state side, which ones are going to agree with this expense and which ones are not. One other subject that I think is important to talk about is interest expense limitation. And the statute is 163J. On the federal side, there is a limitation on what you're allowed to use for interest expense. And there's a calculation that I show right here from the 2018 to 2021. Previously, you could compute your interest expense limitation by taking your taxpayers' interest income, floor planning, financial interest, and then 30% of your ATI, your adjusted taxable income. And it was calculated before you took an expense for depreciation, amortization, or depletion. And so what that means is there's a limitation on your interest expense, and it's calculated using 30% after you've included depreciation, amortization, and depletion. Now that's obviously a big deal if you're also considering what we just talked about regarding bonus depreciation, because if you have $500,000 of interest expense, and I've seen clients who have significant interest expense, you might not be able to claim all of that interest expense on your federal return. What ends up happening is it gets disallowed, and then you get to carry it forward. And then if you ever do get to use it in the future, it has a infinite progression, but you end up having to need that. And so for companies that have regular interest expense, they could find themselves limited on a regular basis. And so states, they respond to this differently. Many states will continue to follow based on the rule in conformity, but I have seen a few states, for example, the state of New Jersey, I believe the state of California, there are a few states that decouple from this. And what that means is, even if on a federal basis, you're required to have this interest expense limitation, on your state return filing, Indiana being also one of these, you do not have this limitation, so you're allowed to take this expense. The challenge is that in OBBBA, one of the changes that has occurred is that they have now reverted back to an old rule, which means that the depreciation, amortization, and depletion element of that calculation that I described earlier, that's no longer included. So now you have a bigger base to work with. Not all states are going to agree with that, because that's going to be a significant cut to their budget. And so if you have significant depreciation and then you have significant interest expense, I would give it a second look with regard to interest expense limitation, because you might have a state that does not allow that, and then they're going to require you to disallow that interest expense, which you might be relying on to avoid taxable income. The only other rule that I've included here regarding Section 163J is that there is a rule that's newer for tax periods after December 31, 2025. If you previously had interest that would otherwise be capitalized, you would be able to avoid this limitation. I don't know how many of you have gone through that process, but that effective, not loophole, but that method has been fixed. And so that's no longer going to be something that you can depend on for avoiding this limitation. So there's a benefit and a cost here. The benefit is that you do have a bigger tax base. So if you have been limited in the past, you might be able to take a bigger expense limitation, a bigger expense. But the cost might be that you can't use certain ways out of it that you could rely on previously. With that, I'm going to pass it back to Meaghan for some tax planning and risk mitigation.
All right, we're nearing our time, the end with each other. So this is just kind of a little wrap up. I think it's really, really important, and you probably realized through all of this discussion, through all of these changes with OBBBA and how the states are reacting or maybe not reacting yet, or we're waiting to see how they're reacting, or even what we talked about earlier with Nexus and where you might have to file and what documentation you need to have. I think it's really, really important that you speak with your advisor at DHJJ about all of this. You know, at the end of this year, there's going to be some amazing tax planning opportunities and discussions that should be had both on the federal and state side. And for a lot of you that file multiple states, it's going to be really important to at least have an idea of, you know, what the federal changes are going to happen in the specific states that you're filing in and what those states are doing. So, and then part of that discussion also is going to be, you know, how we're leveraging pass-through entity tax and the new SALT deduction cap. And so I think that that's going to be a really big key part of tax planning for this year through 2029. And it's going to be every year, especially as we see how states are reacting. As you can tell with Alex, there was a few states that have already put something out and have either stopped ruling conformity or has delayed certain expenses or full expensing of certain things and whatnot. And so we're going to see if there's any other states that come out with that as well, because there's still time to the end of the year for them to make their decisions on that as well. And then Alex, and then we're done.
So just wanted to recap on some things that we've talked about. Some of the things we started out in the front. Nexus studies are we talked about Nexus earlier, and it's the minimal connection a state needs to tax you. And these issues are always going to be a priority when you have a state that can tax you. And so recommendations that I have are reviewing your sales, property, and payroll. Those are the three metrics that states will use typically to identify whether you have Nexus. And then if you do have Nexus, just identifying responses to that. One of the best ways is through what's called a voluntary disclosure agreement. It's where you effectively anonymously come forward to a state. So the state doesn't know yet your business, but you are allowed to report yourself in an anonymous fashion to agree that if you submit to taxes that are back due for a certain set of period of years, they'll agree to waiver certain penalties, and they'll also allow you to limit the look back. So if you had a state where you know that there's a risk going back 10 years, you might only have 3. And so that's a really advantageous position to take. And then there's also amnesty programs that occur at specific times of the year. So I would just highly recommend that as you're going through this, especially if there is a state where now it is favorable because of these changes, but you have some past risk, just give it a look with regards to VDAs and amnesties, because you might be able to clean things up and then have a good filing process going forward in that state. So thank you, everybody. If you have any questions, of course, feel free to ask, but I appreciate your time today.